Welcome to the Deep Dive, brought to you by Cashflow Lab. We're the channel that, well, really tries to decode markets, money, and, all that complex psychology that goes into wealth.
Exactly. Our mission here is pretty straightforward, really. We want to help you, the listener, make smarter financial choices.
Especially in a world that often feels like it's designed to confuse, not clarify things. We sift through the reports, the forecasts, all that noise.
And boil it down. Get to the essential, actionable knowledge you need, especially thinking about the week ahead, or in this case, the year ahead.
And if there's one topic right now that's causing some real friction, some, serious head-scratching in portfolio planning for 2025.
It's this fundamental question of allocation, isn't it? The whole investment world seems split. Are you chasing growth, or are you battening down the hatches for security?
So today, that's exactly what we're tackling. Our deep dive is called Stocks or Gold, the ultimate 2025 investment debate.
Yeah, because we're at this really critical point. You've got the long-term history.
Which says one thing very clearly.
Right. But then you have the immediate short-term performance, doing something completely different, violently contradicting it, as you said.
So are we prioritizing those potentially massive gains, that long-term exponential growth we expect from the stock market?
Or are we turning to gold? The ultimate protection, the stability it offers, especially now.
We almost have to lead with the numbers causing all this buzz, the shock factor, really.
It's the defining feature of 2025 so far. These year-to-date performance figures are just, well, they're a total reversal of what we normally see.
Yeah.
They definitely grab your attention.
Okay, let's get specific. This is the number that should be on everyone's mind. As of what? Early September 2025. Gold. The asset people sometimes scoff at because it doesn't pay you anything.
Right, no yield.
It's up a massive, almost unbelievable, 29%. Since the start of the year, 29%.
Just let that sink in, 29%.
Okay.
Now, compare that,
Yeah?
just for a moment, with the engine of global wealth, the S&P 500.
Yeah.
By contrast, it's up maybe 5.7%, roughly,
Yeah.
over the exact same period.
Right.
So that sets up the tension perfectly, doesn't it? That's the core question for this deep dive. Why? Why is gold crushing stocks right now so dramatically?
Is this just a blip? A fleeting moment driven by fear?
Or is it something more? A structural shift? Does this demand we completely rethink that classic, say, 90-10 portfolio?
To really understand the stakes, I think we have to start with the reigning champion, right? The benchmark asset for long-term wealth, stocks.
Makes sense. Let's dedicate this first part to laying out the fundamental case for equities. Growth, yes, but also liquidity, and just their undeniable power over the long haul.
So just to be clear, when we talk about investing in stocks,
You're buying a piece of a company.
Yeah.
Simple as that. Ownership in a corporation that's hopefully alive and kicking.
so your return is directly linked to how well that company does. Its ability to innovate, make money.
You generate cash flow, navigate the economy. Yeah, stocks are inherently generative. They create value. Gold, on the other hand, is passive. It just holds value, or aims to.
And the main appeal, the reason stocks are the bedrock of, almost every pension fund, every long-term savings plan.
It's the potential for much higher returns, significantly higher over time. Gold tries to keep up with inflation, maybe beat it a bit.
But stocks, they aim to blow past inflation exponentially. You get to participate in actual economic success, technological breakthroughs.
But what makes that possible, partly, is the flexibility you get. The diversification opportunities within the stock market itself are huge.
You can spread your money across different sectors, different countries. That's the basic level.
Right, but for someone really following the market, like our listeners, it goes way beyond just simple sector allocation. You can get much more sophisticated.
How so? Can you elaborate on that beyond just, say, tech versus healthcare?
Sure. We're talking about things like factor investing.
Yeah.
Or smart beta strategies. So instead of just buying a broad tech fund, you might diversify across different styles or risk premiums that have historically driven returns. Think value stocks versus growth stocks, or high momentum stocks versus low volatility stocks. You allocate based on these underlying factors.
So you're managing volatility within your stock holdings.
Precisely. So if one factor, like maybe high-flying growth stocks, hits a rough patch, your exposure to, say, high-quality value or low-volatility names can act as a kind of internal cushion.
That level of complexity,
Yeah.
you just don't get that with a bar of gold.
Not at all. Gold is gold. Stocks offer this intricate internal diversification potential.
And that complexity delivers not just the potential for capital appreciation, that's the main goal, but also huge operational benefits, liquidity being a big one.
Oh, absolutely critical. Let's define that clearly. Liquidity is just how fast and easily you can turn an asset into cash.
Without tanking its price in the process.
Exactly. And stocks are incredibly liquid. You decide you need the money, you place a trade, and the cash settles in, what, 2 business days? T+2.
And even moving to T+1 in many places soon.
Yeah, right, even faster. That ease of transaction is a massive plus compared to, say, selling property or, well, figuring out the logistics of selling physical gold. That takes time and effort.
So how do people actually access the stock market? Our sources point to 2 main ways. First is direct ownership, picking individual stocks yourself.
Right. And that path, well, I mean, a lot of homework, constant research into specific companies, management quality, debt levels, competition.
High potential reward, maybe, but also have high effort, high risk if you pick wrong.
Which is exactly why most investors, let's be honest, use the second path, pooled ownership, through ETFs and mutual funds.
Okay, we mentioned these pool money, but let's get a bit more technical for our listeners who are likely familiar but might appreciate the finer points. What are the practical differences between an ETF and a mutual fund, especially thinking about taxes?
Yeah, this is a really important distinction. It's not just about pooling money. Traditional mutual funds, they typically price just once a day, right, at the end of trading based on their net asset value or NAV, and they can be less tax efficient. Here's why. If lots of people want their money back, redemptions, the fund manager might be forced to sell some underlying stocks to raise cash.
And if those stocks have gone up a lot,
bingo. Those capital gains get passed through to all the remaining shareholders in the fund. So you could end up with a tax bill even if you haven't sold any of your own shares. Not ideal.
Ouch. Okay, so how are ETFs, exchange-traded funds, different?
ETFs are structured differently. They trade on an exchange all day long, just like an individual stock. So you get that intraday liquidity we talked about.
Right, you can buy or sell anytime the market's open.
And crucially, they are usually much more tax efficient. They use this in-kind creation and redemption process. It sounds technical.
But the upshot is?
The upshot is the fund can often get rid of those highly appreciated stocks, the ones with a low-cost basis, without triggering a big capital gains tax event for the shareholders who are just holding on.
That's a huge structural advantage, especially if you're investing long-term in a regular taxable brokerage account.
Massive. It really underscores the sophistication stocks offer. But, and it's a big but.
We have to talk about the major drawback, volatility.
Exactly. The flip side of high potential returns is the risk. You could lose some, or even in worst cases, all of your capital if a company goes bust.
Or even if good companies get dragged down in a big market correction or a recession.
Right, and that volatility, it demands more than just research. It demands a clear understanding of your own risk tolerance. Investing in stocks is about growth, yes, but it needs active thought, ongoing assessment, and accepting potentially higher risk compared to a purely defensive play.
Okay. So that's the case for stocks. Growth, liquidity, sophistication, but with volatility. Now, let's pivot. Let's flip the coin and talk about the asset that's making all the headlines this year.
The one generating those, as you said, mind-boggling short-term returns.
Part 2, the case for gold. Defense, safety, and whatever is fueling these huge 2025 tailwinds that have pushed it up 29% so far.
Gold's traditional role in a portfolio is really as a diversifier, a powerful countercyclical one. It has this remarkably low correlation with stocks and bonds.
Meaning when stocks or bonds are doing badly?
Gold often holds its ground. Or, as we're seeing in 2025, it can actually go up significantly. It tends to zig when other major assets zag.
So it's primarily defensive, a store of value.
Precisely. And its fundamental strengths really revolve around providing stability. Its reputation as an inflation hedge is legendary.
When the cost of living is soaring, gold is supposed to help your money keep its value, its purchasing power.
You might not get richer in real terms after inflation, but the idea is to stop your existing capital from losing its punch.
And beyond just inflation, it's seen as a bedrock during economic and geopolitical stability issues, right?
Absolutely. When things feel uncertain, globally, maybe conflicts, trade wars, worries about the whole financial system, investors tend to flock to gold as a safe haven.
Why gold specifically?
Well, partly because it acts like a universal currency, but also because of something really fundamental. No counterparty risk.
Okay, explain that again. Because that's a massive difference from stocks or bonds.
Right. When you buy a stock, you're relying on that company to perform, not go bankrupt.
Right.
You buy a bond, you're relying on the issuer, maybe a government or a company, not to default. That's counterparty risk. Risk tied to another party's performance or solvency.
But with physical gold?
With physical gold in your hand, its value doesn't depend on anyone else's promise. It's tangible. It's recognized globally. It's held value through, millennia of empires rising and falling.
That absence of institutional risk,
Yeah,
that's why it shines when people worry about the system itself.
exactly. Which brings us right back to the current momentum. Why the explosive 29% jump in 2025? It's not just vague worry. It seems driven by specific interconnected anxieties.
The sources seem to highlight three big things pushing demand right now.
Yeah, first is this pervasive concern about tariffs and trade friction escalating. Tariffs are inflationary, almost by definition.
And they signal a move towards protectionism, which gums up global supply chains.
Right. And that friction increases the risk of things like currency wars. Countries may be trying to devalue their own money to get a trade advantage. When confidence in regular fiat currency starts to wobble,
Gold, the ultimate non-fiat money, looks pretty good.
it soars. That makes perfect sense. Second factor, interest rates. Now, this one's interesting.
Yeah, because historically, high interest rates are bad for gold, right? Gold doesn't pay interest, so why hold it when you can get a decent guaranteed yield from treasury bills?
That's the classic relationship. But rates are high right now, and gold is still up 29%. What gives?
So what's overriding that historical link?
It seems to be sustained inflation expectations. Investors appear to believe that inflation isn't just going to disappear quickly. Maybe they think the Fed or other central banks will eventually have to cut rates to avoid a deep recession.
But maybe not fast enough to stop inflation from eating away at cash savings in the meantime.
Exactly. So the perceived need for protection against future inflation and potential instability is currently outweighing the opportunity cost of not earning interest today. It's a bet on future trouble, essentially.
Okay, that makes sense. And the third driver, this one's less about individual investors.
Right. It's the big players. Central banks. Globally, central banks have been buying record or near record amounts of gold bullion.
Why are they doing that?
Diversification, mostly. Trying to reduce their reliance on traditional reserve assets like the US dollar, often driven by geopolitical shifts, and a desire for assets that aren't tied to any single country's policies or potential sanctions.
And when these massive institutions are buying consistently,
It puts a pretty solid floor under the gold price.
Yeah.
Retail investors, individual investors like you, see this buying, they see the price rising, and it creates a self-reinforcing cycle. They start chasing that momentum.
and all of this worry, this institutional buying, it's leading to some pretty bold predictions.
Yeah, you can't ignore them when they come from major players. We saw that significant forecast from JP Morgan Chase. They think gold could potentially hit over $4,000 an ounce.
$4,000? When?
Their projection was looking out towards the second quarter of 2026. Now that's a forecast, not a guarantee.
Of course. But a headline number like that definitely fuels the fire, doesn't it? It draws in even more attention, more momentum chasing money.
Absolutely. It adds another layer to the current rally.
So if you're listening and thinking, okay, maybe I need some gold, how do you actually do it? What are the options for getting gold into your portfolio?
Well, there are a few main ways, each with its own pros and cons. The most direct route is buying physical gold or bullion, actual bars, coins.
Holding it in your hand, or more likely, a safe.
Right. This gives you the absolute lowest counterparty risk. You own the metal directly, but...
Here come the practicalities. Storage, security, insurance.
Exactly. Those costs aren't trivial. You have to factor them in. Where do you keep it safely? How much does insurance cost? It adds complexity and eats into potential returns.
Which is why a lot of people prefer indirect ownership using the financial markets, like digital gold through ETFs.
Yeah, gold ETFs are very popular. They pool investors' money to buy and store large amounts of physical gold in secure vaults. You buy shares in the ETF, and the share price tracks the gold price pretty closely.
So you get exposure to the price of gold without the headache of storing bars under your bed.
Essentially, yes. It solves the storage and insurance problem, and it's very liquid, like a stock.
What's the other main indirect way?
Investing in mining stocks. Buying shares in the companies that actually dig the gold out of the ground, or mutual funds that focus on these companies.
Now, this sounds like it could give you extra bang for your buck if gold prices rise. Leverage, maybe?
It can offer leverage, yes, but you're reintroducing company-specific risk, big time. Well, the price of your mining stock doesn't just depend on the gold price. It also depends on how well that specific company is run. They could have a labor strike, an environmental disaster, unexpected operational problems, bad management.
So the price of gold could be soaring, But your mining stock could still tank if the company messes up.
Precisely.
Yeah.
It really dilutes the core, defensive, safe haven nature of holding gold itself. It's a very different type of investment, much riskier.
Good distinction. Okay, let's talk drawbacks of gold itself, not just the miners. It's defensive, yes, but for someone focused on building wealth.
Its main flaw is clear. Physical gold doesn't do anything. It just sits there. It pays no dividends, generates no cash flow.
It's purely a bet that someone else will pay more for it later than you did.
Right. It's passive. And that passivity comes with costs, not just storage, but also, importantly, from the tax authorities.
Yes, the tax implications.
Yeah.
This is something that often catches people by surprise, isn't it?
It really does. The IRS, the Internal Revenue Service in the U.S., doesn't treat gold the same way it treats stocks or bonds. It classifies gold as a collectible asset, like art or rare stamps.
And what does being a collectible mean when it comes time to pay taxes on your profits?
It means generally a higher tax rate. If you hold gold for more than a year and sell it for a profit, those long-term capital gains are typically taxed at a maximum rate of 28%.
28%. How does that compare to stocks?
Significantly higher for many people. Long-term capital gains on stocks are usually taxed at 0%, 15%, or 20%, depending on your overall income level. That 28% flat rate for collectibles can take a much bigger bite out of your gold profits.
Wow, that's a really significant difference. If your goal with gold is protection, that tax hit seems counterproductive. Is there a way around it?
There is. And this brings us to a specific planning tool, the Gold IRA.
An IRA being an individual retirement arrangement or retirement account?
Exactly. A Gold IRA is a type of self-directed IRA. This structure specifically allows you to hold certain types of IRS-approved physical precious metals, specific coins or bullion bars of required purity inside your tax-advantaged retirement account.
So by putting the gold inside the IRA wrapper,
You shelter the gains from that higher collectible tax rate. If it's a Roth Gold IRA, qualified withdrawals in retirement, including the gains, are potentially tax-free.
and a traditional gold IRA.
The gains grow tax-deferred. You only pay income tax when you take the money out of retirement, just like a regular traditional IRA.
So the gold IRA structure basically neutralizes that major tax disadvantage of holding gold directly.
It does. It's a crucial piece of the puzzle if you're serious about holding gold for the long term as part of your portfolio, allowing you to maximize its defensive benefits without that punishing tax hit.
Okay, that's incredibly useful practical knowledge. So now we have this picture. Gold crushing stocks, short-term, 29% consensus, 5.7%, driven by fear and forecasts like Fortale Gold. But we also have the long-term philosophy backed by data that stocks are the real wealth builders.
Which sets up part 3 perfectly, the data and expert opinions. We need to synthesize this historical context with the jarring recent reality.
We absolutely cannot let the noise of 2025, however loud it is, completely drown out the signal from the last, 50 years?
Right. We need context for that 29% gain. Gold ownership was re-legalized for U.S. individuals back in late 1974. So tracking performance since then gives us a really solid long-term perspective, over half a century of data.
Okay, so let's look at the numbers. Stocks first. The S&P 500 from roughly 1974 through August 2025.
It went from about 67 points up to over 6,250.
That translates to a return multiple of
A massive 93.2 times your initial investment, 93.2x.
just staggering growth. What does that work out to annually?
That's a compound annual growth rate, the CAGR, of about 9.4% per year, averaged over that entire period.
To put that in perspective, $10,000 invested back then in just the S&P 500 index.
Would be worth over $930,000 by August 2025. And that's just price appreciation, not even counting reinvested dividends. That's the power of compounding in the stock market we always talk about.
Okay, unmatched engine. Now gold, same period, 1974 to August 2025.
Gold started around $195 an ounce. By August 2025, it was up to about $3,360.
So a good return, but how does a multiple compare?
The return multiple for gold over that same time frame was 17.2 times, 17.2x.
So 17x for gold versus 93x for stocks. A huge difference.
Huge. The KGR for gold works out to 5.8% per year.
So 9.4% for stocks, 5.8% for gold. That difference, about 3.6% per year.
It might not sound like much year to year, but compounded over 50 years, that's what creates that enormous gap, 93 times versus 17 times.
The conclusion seems pretty stark from the long-term view.
Undeniable, really. Historically, gold simply does not outperform the stock market over long periods. Its role isn't to be the growth driver.
Its role is
Portfolio insurance,
Yeah.
protection,
Yep.
stability.
Okay, but let's challenge that stock number slightly. We know gold is famed for inflation protection. Did it at least do its job there over those 50 years? How did it stack up against rising prices?
Now that's where gold really shines. That's its specific utility. Over that same 1974-2025 period, gold didn't just keep pace with inflation.
No.
It outpaced inflation by nearly 3 times.
3 times. Wow. Okay. So while stocks delivered far more nominal growth, gold actually did a much better job of preserving and even enhancing real purchasing power during that inflationary half century.
That's the core argument for holding it. It's not meant to make you rich. It's meant to make sure the wealth you have stays valuable, especially when the value of regular money is being eroded.
But we still keep coming back to this paradox. Long term, stocks win big, 9.4% CAGR. Short term, 2025 YTD, gold wins huge, 29% as 5.7%.
And this reversal, as we discussed, it seems entirely driven by those acute fears right now, the geopolitics, trade wars, the uncertainty around inflation and interest rates.
And those fears are amplified by predictions like that JP Morgan $4,000 target. We have to consider the risks around that too, right? What could derail that forecast?
Absolutely. That $4,000 number isn't guaranteed. What happens if those underlying drivers suddenly reverse?
Like if geopolitical tensions ease up unexpectedly, or if the Fed manages a perfect soft landing, taming inflation without a recession, and maybe even cutting rates confidently.
If that fear factor evaporates the trade friction, the high inflation worries, then the primary support for gold's current rally disappears almost overnight. Remember, gold offers no yield.
So the opportunity cost comes back into play.
Exactly. If inflation is under control and you can get a decent, safe return from bonds or T-bills, and stocks look set for growth again, capital is likely to flow back out of gold and into those yielding or growing assets very quickly.
So that $4,000 target really depends on things staying uncertain or getting worse?
Pretty much. It relies on a continuation, maybe even an escalation, of the current global instability. It's a high-conviction bet, but also carries significant downside risk if the narrative changes.
Which really highlights the classic investor dilemma, doesn't it? Chase growth when stocks are hot, chase safety when things look scary.
And that brings us squarely to the most important part for our listeners. Part 4, practical advice. How do you actually balance this? How do you think about portfolio construction and your own risk tolerance in light of all this?
So what's the takeaway for someone listening right now trying to decide their 2025 allocation? Do you ignore 50 years of history and chase the $4K gold prediction?
Or do you ignore the very real fear and instability of today and just stick rigidly to the historical 93x winner stocks?
The expert consensus, from what our sources show, seems pretty consistent on this.
Yeah, almost unanimous, actually. The recommendation is generally that most investors should probably own both assets, both stocks and gold.
Why both?
Because they serve different complementary purposes for long-term financial goals. You need the growth engine of stocks to build wealth for your future.
And you arguably need the stabilizing insurance of gold to help protect that wealth in the present, especially during turbulent times.
We really have to hammer this point home. Gold is primarily insurance, not a growth investment. Its job is to hedge against those tail risks, the low probability but high-impact events like hyperinflation or a major financial crisis.
And to diversify, to smooth out the ride during normal market downturns, it's not there to get you those huge compounding returns like stocks aim for.
Right. And the sources give some pretty specific guidance on how much gold. What's the recommended allocation range?
Generally, experts suggest holding somewhere between 5% to 10% of your investable assets in gold.
5 to 10%. That range seems to be the sweet spot. Enough to provide a meaningful cushion, some real ballast to the portfolio when things get rough.
But not so much that it becomes a major drag on your overall returns during the good times, during those long stretches when equities are climbing.
A simple example to visualize it. A portfolio that's 90% stocks and 10% gold. That 10% might feel like dead weight sometimes when stocks are booming.
But in a year like 2025.
In a year like 2025, that 10% delivering a 29% return provides a really valuable cushion. It helps offset the volatility or slower growth in the much larger 90% stock portion. It smooths the ride considerably.
But here's a crucial point about making this structure work. It's not set it and forget it, especially not now.
Absolutely not. The need for active management, or at least active monitoring and rebalancing, is critical. You can't just establish that 90-10 ratio and ignore it for years.
Why not? What happens?
Well, think about this year. If you started 2025 with exactly 90% stocks and 10% gold, given gold is up 29% and stocks only up, say, 5.7%.
That ratio has already shifted significantly.
Massively. Your gold allocation isn't 10% anymore. Because it grew so much faster, it might now be closer to 12%, 13%, maybe even 14% of your total portfolio value. It drifted upwards.
And active management says you should.
It says you should rebalance periodically. Sell some of the asset that is outperformed, in this case, gold, to bring its weighting back down to your target, maybe that 10%.
And what do you do with the proceeds from selling the excess gold?
You reinvest that profit back into the asset that underperformed in this case. Stocks bringing its allocation back up to 90%.
So rebalancing forces you to systematically sell high and buy low.
Essentially, yes. You're locking in some gains from your insurance asset when it's done well and redeploying that capital into your growth asset, making sure you're positioned to capture the eventual recovery in stocks. It imposes discipline.
Makes sense. But ultimately, that perfect 90-10 or maybe 9-55 or 80-20, it really depends on the individual, doesn't it?
Entirely. It comes down to your specific financial goals, your time horizon, and crucially, your personal tolerance for risk.
If you're, say, 25 years old, saving for retirement 40 years away,
you might be perfectly comfortable with 95% or even 100% in stocks. Your focus is maximum long-term growth, and you have decades to ride out the inevitable volatility, chasing that historical 9.4% CAGR.
But if you're nearing retirement, or if you're just someone who lies awake at night worrying about the current economic climate, the trade wars, the inflation,
then that 10% gold allocation, maybe even a bit more, starts to look extremely appealing. It's that safety net. It can provide peace of mind, letting you sleep better while your stocks navigate the uncertainty. The data gives us powerful insights, but the final decision has to fit your situation.
That's a great way to frame it. Okay, what an incredibly detailed deep dive. Let's try and quickly recap the absolute core points we've covered.
All right. Stocks, the undisputed long-term growth champion. History shows that massive 93.2x return since '74, a 9.4% compound annual growth rate. They're the main engine for building wealth.
But they come with volatility. They need active management or at least monitoring, and things like tax-efficient ETFs are often the best way for most people to access them.
Then there's gold. Its strength is stability, defense. It's a proven inflation hedge, outpacing inflation by nearly 3x historically. It offers that low correlation to stocks and no counterparty risk.
And right now, in 2025, it's delivering huge short-term gains. That 29% number is impossible to ignore, driven by very specific current fears: tariffs, inflation, interest rate uncertainty, plus big central bank buying fueling forecasts like that $4,000 target.
But remember the drawbacks: no yield, and that higher collectible tax rate unless you mitigate it.
Which leads to the expert consensus. Balanced diversification is key for most. Own both. A 5% to 10% allocation to gold is generally recommended as that portfolio insurance layer.
And remember to rebalance periodically.
Okay, so that leaves us with our final provocative thought for you, the listener, to mull over as you think about applying this. It builds directly on something we discussed.
We highlighted that the IRS taxes profits on gold held directly at that higher collectible rate up to 28%. But holding it inside a gold IRA avoids that specific tax treatment.
So the question to consider is this. Given that stark difference in tax treatment, and given that gold's primary role is protection, not income generation,
should that recommended 5% to 10% gold allocation be absolutely prioritized for placement inside one of your tax-sheltered accounts, like a traditional or Roth IRA, specifically structured as a gold IRA?
Does doing so maximize the net after-tax benefit of your portfolio insurance, ensuring that if gold does its job during a crisis, you keep as much of that protective gain as possible without giving a huge chunk back in taxes?
It's a crucial logistical question, something to definitely explore, perhaps with a financial planner, as you finalize your strategy for 2025 and beyond. How you hold the asset matters, not just that you hold it.
That's a perfect point to end on. Thank you so much for tuning in to this deep dive from Cashflow Lab. We really hope breaking down the stocks versus gold debate has given you some valuable clarity for navigating these pretty unusual market conditions in 2025.
We'd love it if you'd subscribe to the channel, maybe leave us a rating or review if you found this helpful, and definitely follow us for more deep dives into finance, investing, and the global economy.
Remember, money never sleeps, but smart investors learn how to make it work for them. We'll see you in the next deep dive of Cashflow Lab.